everyone, to another episode of Capitalize on Retirement. Brandon and I are here today to talk about one of our favorite talk tracks. We're going to talk about taxes, more importantly, tax planning. And end of year is it's a crunch time for strategic financial moves. You know, most people kind of think of, when you think of taxes, you're thinking April 15th. And that's the actual tax return deadline. That's when all the preparation has to be done and returns are sent in. But December 31st is our tax planning deadline. So that is a key date in our mind here at Capital Way Wealth Management. That's a date that we always have kind of earmarked on our calendar because we know we have to execute on qualified charitable distributions, donor advised fund, Roth conversions, SALT deductions, capital gains. Brandon and I are going to talk a lot about those today. But Brandon, why don't you kick us off with why year-end tax planning matters rather than April 15th tax preparation?
Yeah, so, now that we have the CPAs here, I think it really stands out to me because I see what they do come April 15th. I mean, they're really looking in the rearview mirror and telling people, okay, here's what you owe. There are things that they could do to help save some tax dollars, but really the future tax savings is what we do. And those things need to be done by the year end. So when it comes to year-end tax strategies, I think one of the things that we always talk about are qualified charitable distributions, right? So if we just kind of jump right in, one of those strategies would be QCDs. And a qualified charitable distribution is when, if you're over 70 and a half, you could gift money directly from your IRA, right? So, where I see this come into play is, let's just say somebody is taking the standard deduction, right? They don't have enough deductions to essentially itemize their taxes. Well, one of the things they could do is they could take the money directly out of their IRA. They don't move that money to their bank account. They actually move it directly to the charity, and then they essentially get that tax benefit because they're not paying taxes on that IRA. They're donating it directly to a charity.
And that's really important. We see that when the families that we serve, when they're RMD age and they have to take an RMD and they're charitably inclined, right? Instead of taking that money out, paying tax on it, because think about all the families that we've served, and one of the questions that we ask in our first appointment is, are you charitably inclined? And more often we hear yes, even if they're smaller dollar amounts, right? So the charity doesn't care how they get their funds, and that'll be repeated as we have these conversations. But charities don't care how they get their funds because they don't pay taxes on it. Yeah. But we could take that money directly from the IRA. We could take up to $100,000, and that'll count toward our RMD every year. We all know about those RMDs, or those required minimum distributions, that are so problematic for people. And we can give that money straight from IRA to the charity and not have to pay the taxes on it, which effectively that allows us to give more money to the charity.
Yeah.
And the charity doesn't necessarily care how they get their funds because they're tax exempt.
Yeah, so, I had a client this year, actually. They had to take their RMDs, their required minimum distributions, and their required minimum distribution was about $100,000 for the year. They were a great saver, and their RMDs are starting to get more and more problematic. Mm-hmm. So they were projected to be over one Medicare tier by about $1,000. Mm-hmm. Now, when I looked at that, part of the tax planning is like, hey, you want to donate to charity, but you're going to take this money out of your account and not get any tax benefit. Let's do a QCD for $5,000. Let's get you under that Medicare tier. And now they saved money. They saved those Medicare surcharges because they did that strategy. They took advantage of it.
And that all just ties back to our conversation today in tax planning and why it's so important of understanding where you're going to be at, building out the tax models. That's what the CPAs have helped us with so much, that we actually have models of our clients' tax returns. We know where they're going to be at, and it allows us and them to make these educated decisions as opposed to, should I give away? If I'm going to give some money away anyway, what's the best way to give it?
Yeah.
So really important stuff there. And again, that's why the end of the year is so important for us. So QCDs, if you're over 70 and a half, if you are giving to charity and you're not giving above the standard deduction, which is really high, over it's $34,000 this year, QCDs are a great opportunity for you to leverage your tax planning by the end of the year.
Yeah, and it must be done by December 31st. So
Yes.
it's one of those. So.
The next one we want to talk about, this one's really kind of near and dear to us. We help the families that we serve with these. Donor advised fund. So do you want to explain what a donor advised fund is, and we'll talk about the benefits?
Yeah, so a donor advised fund is an account where essentially you get to move money into an account now. You get the deduction now up front, but you don't have to donate all of that money up front. You can actually donate that money over a longer period of time. So the benefit of that is essentially, let's just say, for instance, right now, a lot of people are taking the standard deduction because it's so high. If you're a married couple, it's over $31,000 this year. So I had a family a couple of years ago who said, we used to donate $5,000 a year to charity, and we would get a tax benefit for it. Well, now because the standard deduction's so high, they were not getting any tax benefit for donating that $5,000, so they stopped. So I said, hey guys, there's a lot of different strategies around this, but you have this highly appreciated stock, Apple stock that you bought a long time ago. Let's donate $50,000 to the donor advised fund. Now we're going to itemize our taxes and get that $50,000 benefit, but we're basically going to get the tax benefit of Apple stock. It's tax exempt when we sell it in the donor advised fund. And now they're going to donate $5,000 for the next 10 years and potentially even more because it's invested.
Yep. So it gives you the ability to bunch a few years of donations together so you get a larger tax deduction. But now I think the main thing from that is once we do that and we can itemize, now we could start using our very generous SALT deduction now that we have that used to be capped at $10,000 that is now up to $40,000.
Yeah.
So now we're getting into itemization where we have other deductions that we can go ahead and take and begin to leverage there.
Yeah, that's a good point. And the other thing is you mentioned the SALT deduction. There's income limits on that. So married couple over $500,000, you start to lose those SALT deductions. And so one of the things is if you have a donor advised fund in place, well, maybe that gets you under certain limits, or maybe you find other strategies that get you under certain limits so you can lower your income.
Yeah, I mean, I have a good example on that. I had a family, they were high income earners, they were at $550,000. They were donating $10,000 a year in after-tax money, which is how most people are donating today without proper planning, to a charity. And I said, hey, well, if we can lump that amount together, and they had a very highly appreciated stock. It wasn't Apple stock like you mentioned, but they had a very highly appreciated stock position that we kind of wanted to use to give to the charity. So we moved that over. That got them a $50,000 deduction. It dropped them below $500,000. So now they could get the full impact of the SALT deduction. I mean, we're talking about moving massive numbers, and that's where it really helps with the CPAs along with us as the planners, because the CPAs are helping on that side, and how can we help save taxes in this current year?
Yeah.
And then we are working on how can we minimize taxes over your lifetime.
Right.
Donor Advised Fund is an awesome tool because you could turn your tax money into a very large impact through a charity.
Yeah. I mean, especially if you have highly appreciated stock positions. I mean, it's one of those things where you never have to pay the tax bill. Nobody does. And so, maybe it is Apple stock where you have one tech position like Apple or Nvidia that has gone way up, and now it's a huge portion of your portfolio, and you want to take some risk off the table. So there's all different strategies around it, but it can be very powerful and give you some huge tax deductions.
Yeah, and obviously the first two strategies we talked about, qualified charitable distributions and donor advised funds, you have to be charitably inclined for those. But I think the thing is, you're not giving all that money to a charity today. Well, the QCD you kind of are, but the donor advised fund you're not. You are earmarking it into a charitable fund that can be used for future gifting later. And that kind of brings us to our next topic, which is how we're funding a lot of these. So this will kind of tie in, and then we'll move to Roth conversions. But capital gains are a big one. And when we talk about capital gains, we're talking about, I mean, obviously there's unrealized gains and realized gains. And realized gains are when we sell a position. But then there is what's called phantom gains. And we've been seeing this more often nowadays than ever. Phantom gains are when I own a mutual fund. And at the end of the year, I didn't sell a single position inside that mutual fund because it's a pooled investment. I still have to pay taxes on the portion of that investment that I own. That is called a capital gain. There are ways, and right now, well, you want to touch on why now is an important time for that as companies are issuing those?
Yeah, so, one of the things that I would say is, like, we deal with this a lot. When we receive mutual funds, people move positions over to us. You have fund distributions, and you can't control that. Mm-hmm. And so, once again, there's just a lot of ways with these especially capital gains, long-term gains. I actually have a story about one of our clients who recently came over. They were working with another advisor, and that advisor, they didn't focus on tax planning at all. They had some highly appreciated positions. They sold a lot of stock because they made money, and they said, hey, we're going to reallocate and buy some different stock. Well, what they did is they realized $90,000 of capital gains, of long-term capital gains. And so when they came over to us, their biggest concern was, hey, I want to do Roth conversions. I want to start moving money from IRAs to Roth because I'm in a low tax bracket. Well, the problem with that is the top of the first capital gain limit is $96,000. So they were at 0% capital gains. So on that $90,000 that they realized, they were paying 0% tax on that. They had no other income coming in. They were living on cash. And so if I were to do a Roth conversion, that would not only have them pay taxes on the Roth conversion, but also pay 15% tax on the capital gains that they realized. So we decided to not do any Roth conversions, and they're not going to pay any capital gains on that. So I think that's why it's important to look at everything, because if I would have just said, hey, makes sense, you're in a low tax bracket, do the Roth conversion, they would have paid a lot more taxes than they needed to.
I think that's a great point. Obviously, we're in wealth management. In investment management, a big piece of that, our last episode was all about investments. And today we're up here talking about taxes. And many advisors would have missed that, and that would cause a huge impact for the client, because now we're pushing them through ordinary income tax brackets.
Yep.
We're pushing them through capital gains tax brackets. So by us having the knowledge of the tax code, our CPAs being involved, I mean, we could provide so much leverage, and we've seen it with the families that we've served. I saw it. I have somebody coming in later today. Last year, just on the Phantom Capital Gains Mutual Fund, their capital gain distribution in 2024 was $50,000. Now, if they hold this position until mid-December, that is going up to $150,000. Now, they haven't sold a position. Now, whether we do anything or not, whether we do a donor advised fund, which is an option, we sell some of that, whatever we decide to do, at least we know that, and the client is prepared for that, because those are taxed. I mean, he's a high income earner, so now we're getting 20% capital gains. We got 3.8% net investment income. State of Pennsylvania 3.7. Like, these are big things that people just aren't aware of, and we're getting a little technical, but it is so important to have your tax plan aligned with your investment strategy.
Yeah, like you said, there's a lot of weeds that you could go down, and once you start going into these things, you realize how complex it can be. But if you have somebody quarterbacking this for you and not just saying, because Roth conversions, I hear everybody talking about this now. And Roth conversions can be very, very powerful, but you have to look at all the other stuff as well. You can't just say, let me do a Roth conversion, because if you don't have something that's saying this is how it's going to impact all the other pieces of the plan, it can throw everything off.
Oh, 100%. I mean, Roth conversions they're kind of in the press nowadays, and they're a huge deal. We've been doing this for a number of years now. We've seen the power in this. We see how important it is. And I think, just to summarize everybody, a Roth conversion is taking money from your tax-deferred vehicle, from your IRA, your 401k, your 403b, whatever it is, and moving that money to a tax-free vehicle like a Roth IRA. And to get that there, we have to pay some taxes, right? But we're paying taxes at rates at which we know, and that's so we could get tax-free growth, tax-free distributions, and tax-free money to our children later on. And I mean, Brandon, talk about why. Well, let's talk about what people have to know to execute on a strategy like that.
Yeah, so, I mean, first thing that I look at when I'm looking at Roth conversions, I look at what is their income right now and what is their income going to be in future years. So, a lot of the times, and I also look at not only what their income is now and what it is in the future, I look at what is their income going to be forced to be in the future. Because a lot of the times, the retirees that we serve, the families that we serve every day, some of them do a really good job of saving into these tax-deferred accounts like IRAs, 401ks, but they don't realize that the required distribution that they're going to be forced to take out is going to push them into higher tax brackets than they even were in their working years. And so we want to look at, am I going to be in a higher tax bracket down the road? And maybe when you first retire, you're in a very low tax bracket, which means maybe you do a Roth conversion, but you got to look at all the pieces of the puzzle. So you definitely want to look at where's my income now and later, and then you want to look at what am I going to be forced into down the road.
Yeah, because once you hit RMD age, I mean, you're on the government's plan, not on your plan. And we think there's a probability that taxes will go up down the road at some point in time, but I think the most important thing and probably the biggest disconnect on doing these Roth conversions, one is people want to do them just to do them, but I think two main variables. Number one is if you're married, we call it the spousal tax trap.
Yeah.
So if we're married and let's say I have $2 million in an IRA, well, in the first year, my RMD is going to be roughly $80,000. Well, if I'm in married filing jointly tax brackets, that's not so bad. But
right.
If one of us were to predecease the other, that RMD does not change.
Yeah.
That RMD is the same. And now I'm in single filer tax status. Now I'm definitely in a much higher tax bracket.
Yeah.
So there's a high probability at some point in time these RMDs are going to catch up to you. And then when that money goes to your children, they have to pay taxes on all of that money over a 10-year period, which is...
Yeah. I was just going to say that the other thing we look at is, do you want to pass money on? And if so, how are your kids doing? Are they going to be in their peak earning years where they're maybe in the 32 or 35% bracket, and now you're passing them on money, and that's great that you're doing that, but a third of that is going to the government because you didn't do the proper planning.
Yep.
So, it's all about tax arbitrage, and it's like, hey, if your kids are going to pay 35% down the road, but you could pay 12 or 22%, that's a huge tax savings. And I'd rather have the money in our pockets than give it to the government.
I haven't met a family yet if we kind of said, hey, you could pay 13% less for your kids today than what they'll pay to the government later. I mean, yeah. I don't know anybody who would be against it. I think it's having all the pieces of the puzzle put together. That's having a plan. That's having a tax plan, how all these things work. And I think the one thing is all of these tools kind of work together. Like typically we're migrating donor advised fund, Roth conversions, the SALT deduction, all of these things together. So it's not that they're all just one-off strategies. They have to all work and fit together because there's true leverage there.
Definitely. And I'll actually give an example. So one other strategy that we talk about every so often is a charitable remainder trust. Mm-hmm. So we had a client who was selling a business asset, and they were going to be in the 20% capital gains bracket because they sold their business. They were going to be pretty high up in terms of income that year, and especially their capital gains. What we did is we structured a strategy to move money into the charitable remainder trust so that they didn't pay all that tax at one time. The goal was to get them from the 20% bracket down to 15%, which I know it's only a 5% difference, but it's a 25% tax savings. Yeah. So it's a big deal. And they were very charitably inclined. So you mentioned this needs to make sense. Like, you're not going to do a charitable remainder trust if you're not charitably inclined.
No.
But the benefit is they get a huge tax deduction up front. They get to defer the tax bill over future years, hopefully pushing them down to 15%. And then they get income from that charitable remainder trust. So it's a win-win-win. And then some of that money goes to the charity on the back end. But huge tax benefits up front. They get income. They hopefully save some tax dollars along the way, and it goes to charity on the back end.
Oh, it's a tremendous opportunity. And again, like all these strategies have to be in place by the end of the year. That's why we wanted to make sure this episode got out. These are things that we're working on with the families that we serve. I think the other thing is, we kind of mentioned the SALT deduction. We don't have to go into it too much because that is very specific to your situation. But I think being able to understand how the tax code works, and SALT deduction is state and local tax limits, and it used to be at $10,000. Now you can itemize up to $40,000 there. But we could also add things such as the new car that's been manufactured in the U.S., those deductions. So there's a lot of other things that we could add and bunch those together with charitable contributions.
Yep.
There's a lot there.
Yeah. There's a lot of tax planning that should be done by the end of the year, and I think one of the things that really makes us stand out is working with our clients and having a team approach and having an advisor and a CPA working together. Right? I mean, even like people not understanding what they have available at work. I just had a client who's in the 32% tax bracket. They didn't even know that they had a non-qualified deferred comp plan. So we could put money in there, defer taxes at 32%, and pay them at 22% when they retire. It's just little things like that. I think having those conversations at the end of the year really makes sense, and that's what your advisor should be helping you with.
And I'll piggyback into that though, but you have to have a plan to know that you're going to be in the 22%. That, most people
definitely
don't have a plan, right? They've accumulated, and that's been fantastic. There's so many people who come into our office for the first time, and we ask them how, do you have a retirement plan? And more often than not, we hear, no, I've saved money. They've done their part, and you need somebody else to help get you to and through that next phase.
If you're a maximizer and, that's what you're really trying to do, that's what you should be looking to do, by the way. I mean, if you save a lot of money and you sacrifice all these years of working hard and saving money, you should be looking at how do I maximize every single dollar that I have.
I think about what we do. We do it every year. I mean, we are always looking to try to find things that we could take advantage of through opportunities in the tax code. So a lot of the times when these things are getting brought up, we're executing on them ourselves. So we know exactly how they work because we're doing it.
Yep.
One other thing, you mentioned employer plans. So I know some major changes are coming into employer-sponsored plans next year, 401k contribution limits. So Brandon, if you could touch on the 401k contribution limits for next year before we kind of wrap this thing up.
Yeah, so 401k limits are right now, as of this year, if you're under 50, $23,500. They're going up $1,000. So the new limits are going to be $24,500, and then you get an $8,000 catch-up contribution. So that would push you to $32,500 if you're over age 50. But there's a stipulation on the catch-up contributions moving forward, where those catch-up contributions, that extra $8,000, has to go to a Roth IRA. Now, if your plan doesn't have a Roth component to it, then from our understanding at least, you can't make those catch-up contributions. And I think the government's doing this because they want some of those tax dollars now.
Yep. They don't want people to defer all $32,500 like they were able to do over the last 5 years. Well, the contribution limits change, they go up, but now that money has to go to a Roth. And if your plan, and we're here in Western PA, so there's a lot of older plans that have been in existence for a long time, and there's a lot of these smaller employers who don't have Roth 401ks, Roth 403b. So those people who are over 50 and want to maximize their savings aren't going to be able to put as much into their employer-sponsored plans. Doesn't mean they can't contribute, but they can't put it in there. So employers, that's a good opportunity for you to take advantage of. Employees, if you're working for an employer, be prepared for that, understand how that works. We have some data on that if you guys have any questions.
Yeah, and then just the last one is if you are age 60 to 63, with the Secure Act, they actually made changes to this. You can put an additional, so not on top of the $8,000, but instead of the $8,000 catch-up contribution, you can actually put in $11,250. So a total of $35,750 if you're anywhere from age 60 to 63, which is a huge benefit. And then the other thing is IRA contributions are going up from $7,000 to $7,500, and the catch-up is $1,100 if you're over 50. So $8,600 total if you're over age 50.
And those are from 7,000 and 8,000. Now they're 7,500 and 8,600. So we're getting more opportunity to save and put money away. Again, like Brandon mentioned, and like we'll talk about, even for these 401k contributions, if you know putting that much money in your 401k is going to knock you down a tax bracket and save you on your average rate, there's opportunity there, and those are conversations that you need to be having. That one more going into next year, so we could kind of prepare and plan for that. But a lot of the other stuff that everything else we've discussed today does have a deadline of December 31st. Make sure you're aware of it. Make sure you have a plan in place for that. Any wrap up on this?
Yeah, I mean, I think the one thing I would say, and I kind of already mentioned this, is just having an approach where you're looking at this every year, because, everybody gets to tax time and they either get a refund or they owe money. You should be looking at this every year to see where you're going to be at the end of the year, and are there any tax strategies? Are there any things that I need to do? Or do I have any outliers? Am I selling a piece of real estate? Am I selling some stock this year? Like, these are all things that your advisor and your CPA should be working on. I think that's what you should be looking for at this point. So,
no, I agree. I mean, I think people are very, very intentional about their investment plan.
Yeah.
Right. What stocks do I own? What bonds do I own? What mutual funds do I own? They're very intentional about that, very aware. But not many people really understand the tax code. And in my opinion, from doing this over the past, however long we've been doing this, the tax code is the biggest needle mover. And taking some of these steps to lower your future tax liability is just, it can really change the game for you.
Yep.
And we've seen it through the families that we've served.
Yeah.
And they've seen it. We hear it all the time.
Definitely. So I think for my takeaway from this would be there's plenty of tax opportunities. Knowing which ones to implement for your situation, it's going to depend, right?
Yeah.
Depends on your situation. It depends on your goals. And so if you don't know that, reach out to us. We'd be more than happy to help you guys. So, but other than that, thank you guys for tuning in to another episode.